prevent the decline of the defined benefit programs, but since it's gone that way, let me ask about defined contribution. How serious a problem is the lack of diversity in the equities, employees who are encouraged to buy in their own company, for example? There have been some changes and some different patterns, I think. But is that a serious problem? And if so, what is to be done about it? Is this legislation that we should be considering?
I consider it to be a very serious problem. Again, there are some risks that in a 401k plan are unavoidable, especially if you're trying to get over the long term some expected return. But over-investing in an individual stock is not sound financial theory, and over-investing in a single stock that happens to be your employer's is particularly problematic because you're not only exposed to that company's well-being through your job, but also through your retirement fund. It is extraordinarily difficult to come up with any scenario where, on average, for workers, it makes sense to be investing so dramatically in your own employer stock. And again, something like 7%, so 1 out of every 15 workers has 90%, 90% or more of their account balance in their employer stock. It's very difficult to justify that kind of lack of diversification under any finance theory. We had discussions earlier about the different funds that are offered, trying to move towards more diversified funds. And just briefly, I would note that while the CD and money markets were only offered by about half the funds, bond funds and stable value funds and what have you would raise that number dramatically and get you close to 100%. But I think moving towards defaults where people are automatically invested in diversified, low-cost index funds offers the most auspicious way forward for balancing the various trade-offs. And I can't justify the over-concentration in employer stock that pervades the pension system.
Other witnesses, and in particular, should we be imposing requirements?
I have some actual real data here. We have the country's biggest database of 401k participants, and the numbers Peter gave had been very representative of what the situation had been prior to Enron. For 20 million individuals that we track, in 2006, the number has now gone down to only 7.3%, which admittedly is still a large number that have 90% or more. The good news, though, is what's going on with respect to the new participants. A lot of that money, as Peter and others have mentioned, is very sticky. Once the money is put in company stock, oftentimes people will not diversify out. The good news is if you look at the new individuals, people who have been in the plan 2 years or less, the number now that have 90% or more in company stock is down to 4.8. That had been up as high as 11.1%.
Will the gentleman yield?
Like Mr. Ghilarducci, or Dr. Ghilarducci and Dr. Weller wanted to get a word in. Yes.
Just if I may, to what extent is that attributable to the QDIA provision?
Well, that's exactly the point I was going to make. Yeah. We don't have the ability to go back and break out to the extent to which employers have either allowed diversification more rapidly on the part of the employees and or change.
But that,
whether,
if I may, that's very material to Mr. Holt's question, though, right? Because it's happening by default. That's nice, but it's not really addressing the problem that he's raising, right? I would.
Well, I mean, one option in our plan, Benefit Street plan, we don't have individual asset classes. We only have portfolios. A lot of the advisors who come to us, a lot of them especially who use ETFs, low-cost index funds, do not have individual asset classes. They only have portfolios, be they target date portfolios or target risk portfolios. So one very simple way to do it is simply eliminate the ability of an individual to buy an individual asset class within a plan. And that may seem a little draconian, but that would guarantee you immediate diversification for all employees.
I would say, like you can never really make a DC plan as efficient economically as a DB plan, but one big step forward is exactly what Peter said. A well-diversified default low-cost index can go a long way according to the calculations by the National Institute of Retirement Security. you can really improve retirement savings here by 20% just simply by giving a better investment option.
A dollar in a defined benefit plan goes further than a dollar in a defined contribution plan because of fees, because of the asset allocation. If you do limit single stock in a plan, that's a good idea. And you also might have the effect of smoothing out the volatility in the stock market, because a place where companies lard up their stock value is by shoving it onto their employees. So you'll have these macroeconomic good effects as well.
Thank you again, Mr. Chairman.
Thank you very much, and I want to insert into the record a statement by Ranking Member Buck McKeon, and also a statement from the American Benefits Council, and the record of